Welcome to this explainer. Okay, let's just dive right in and settle the ultimate wealth-building debate. Should you park your hard-earned money in stocks, or is real estate the way to go? It's an age-old question, right? One that sparks some seriously fierce debates among investors. But today, we're cutting through all that noise. We're going to look at the hard data, the hidden costs, and the ultimate frameworks from top investors to figure out exactly how to build a portfolio that actually works for you.
So how do our brains actually learn to invest? You know that weird thing where you buy a new car and suddenly you see that exact car literally everywhere on the road? Yeah, that's called the Bader-Meinhof phenomenon. When you buy just one single share of a stock, say Coca-Cola, it gives you skin in the game. Suddenly, your brain is triggered. You actually start caring about financial news, dividend dates, and earnings reports, simply because it's relevant to you now. Experts say it takes just 20 hours of focused effort to build true competence. And honestly, buying that first share is the absolute best way to start the clock.
Today, we're acting as a neutral arbiter. Here's our roadmap for this explainer. 1. The case for stocks. 2. The case for real estate. 3. The hidden cost of time. 4. Bridging the gap with REITs. And 5. Building your ultimate portfolio. Let's kick things off with part 1, the case for stocks, unleveraged returns, and ultimate liquidity. If you look at the last 150 years of data, the unlevered return of the stock market has averaged about 10% annually. I mean, that is just incredibly powerful. As a completely passive, unlevered asset, an S&P 500 index fund outperforms just about everything else out there over the long haul. You can open a brokerage app in a matter of minutes, invest $100, and instantly own a piece of real, profit-generating businesses without ever lifting a hammer. It's almost magic. But here's the catch. That 10% return comes with a severe psychological reality check. Volatility. Because stocks are so incredibly liquid, they reprice every single minute. This gives investors what we call screen anxiety. Just look at 2022, where the market dropped 27%. Real estate, on the other hand, it rarely sees nationwide drops. Even the massive 2008 financial crisis saw a roughly 20% drop in housing, but properties aren't repriced daily. You are never forced to see a big red number flashing on a screen, which really helps prevent emotional, panic-driven selling.
So, the crucial point here is that you don't have to guess or gamble to be successful in the stock market. You can use a strict filter to evaluate what are known as dividend aristocrats and kings. These are companies that have paid and actually increased their dividends for 25 to 50 years straight. By checking for a healthy yield over 2%, stable revenue, and a reasonable price-to-earnings ratio of 15 to 25, you really protect your downside. You aren't speculating. You are buying reliable, consistent cash flow.
Moving right along to part 2, the case for real estate, leverage, taxes, and cash flow.
Real estate offers a totally unique total return method. We're looking at a combination of things like cash flow, tax benefits, debt paydown, and long-term appreciation, which is carefully tracked by indicators like the FHFA index. So this isn't just about a stock ticker moving up. It's a truly multidimensional wealth creator. But the absolute superpower of real estate? That's leverage. Think about it like this. If real estate appreciates at an average of 3.4% per year, and you put down 20%, meaning you're levered 5 to 1, your actual return on that appreciation multiplies to 17%. Boom. And when you add in the tenant actively paying down your mortgage, plus potential cash flow, your early returns can hit the upper teens or low 20s. That completely crushes the unlevered stock market average.
But remember, massive returns do not come for free. Real estate offers incredible tax breaks like depreciation, allowing you to essentially earn tax-free cash flow and 1031 exchanges that let you defer taxes indefinitely. However, all of that comes at the cost of liquidity. You can't just sell a house in 3 seconds on your phone if you suddenly need cash. Plus, you are effectively running a small business, which means you might just be the one getting that dreaded 2 a.m. toilet repair call.
Which brings us to part 3, the hidden cost of time, calculating your true investment. Have you heard the tortoise versus hare analogy? It perfectly captures a major trap for new investors. High-income earners, doctors, lawyers, engineers, often want the flashy, fast-paced real estate strategies like flipping or short-term rentals. They want to be the hare. But for a busy professional, the best strategy is actually to be the tortoise. Take that high salary, funnel it into boring index funds or solid turnkey single-family rentals, and just let time do the heavy lifting without the massive stress and costly beginner mistakes.
Let's actually put a real price tag on that time. To learn how to screen tenants, find contractors, and properly analyze deals, it takes about 250 hours.
If your time is worth $50 an hour, your hidden startup cost is $12.5 grand. And if you're a high-earning doctor, that cost is exponentially higher. This right here highlights why some experts highly suggest starting with stocks to build financial competence safely before taking on the massive time and capital risks of a small business like real estate.
All right, part 4, bridging the gap. REITs, the ultimate hybrid asset. So, what if you really want the incredible real estate exposure we just talked about, but without dropping massive capital or dealing with those 2 a.m. maintenance calls? That is exactly where REITs come in. Real estate investment trusts are companies that own and operate income-producing real estate. Think shopping malls, huge apartment buildings, and resorts. They allow you to buy in and get real estate exposure with the absolute ease and liquidity of a stock app. You get the real estate dividends without any of the tenant drama.
But a quick heads up here. Official SEC guidelines strictly warn investors that you must watch out for non-traded REITs. While publicly traded REITs are bought and sold on the open market easily, non-traded REITs can hide their share values for months or even years. They completely lack liquidity, and they often come with massive upfront fees. You always need to ensure you know exactly what kind of REIT you're buying.
Aside from publicly traded REITs, you can safely dip your toes into real estate using some great training wheel methods. You can try house hacking by renting out a spare bedroom to cover your mortgage. Or you can do a live-in improvement. Buy a home, fix it up while you live there, and sell it after 2 years. Why 2 years? Because the tax code actually allows a single person to exclude up to $250,000 of capital gains, and a married couple $500,000, completely tax-free. That's a huge deal. Finally, part 5. Building your ultimate portfolio, the infinity allocation model. So how do we finally resolve the debate and combine these powerful asset classes into one cohesive strategy? The infinity allocation model gives us a phenomenal roadmap. It suggests balancing your wealth out by putting 30% into income-producing dividend stocks, 30% into real estate or REITs, 30% into managed muni or index funds, and keeping a crucial 10% in dry powder cash. That cash buffer is your armor. It absolutely protects you from being forced to sell your stocks or properties during a market crash.
As the SEC points out, and this is critical, understanding the specific, unique risks of all asset categories is absolutely vital before you make your portfolio allocation decisions. The risks in real estate are vastly different from equity risks, and combining them intentionally is what protects your overall net worth.
Because ultimately, the goal here is to avoid what experts call the middle-class trap. This is when you get caught having all of your wealth locked entirely in your primary home's equity and your 401k. Sure, those are great, but they offer zero liquidity and zero cash flow to fund your actual lifestyle before retirement age. You need to deliberately carve out a balanced portfolio that generates real, spendable cash flow today. So now that you have the roadmap to combine these two absolute wealth-building powerhouses, the only question left is this. You have exactly 20 hours to become competent. Will you spend it scrolling on your phone, or will you buy that very first asset today, trigger that frequency illusion, and finally get skin in the game? The clock starts now.